Hello, ladies and gentlemen, and welcome to the first episode of our new weekly series, PWM Tea Breaks. Over a lovely cup of tea, we'll dive into some of the week's biggest stories. We'll be speaking to some of the best minds in the industry, from consultants to chief executives, getting you the best insights. Joining me on this endeavour is a man who needs no introduction, Yuri, the editor-in-chief of PWM. And I've got with me a Moroccan tea here. And Yuri, what have you got today?
Well, Ali, I'm delighted to be discussing these ideas in our tea break from the day's work. And I've got a cup of this rather radiant jasmine tea in front of me. And, you know, the history of this tea, it goes back 1,000 years to the Song dynasty in China. And I think it's quite appropriate today because there have been so many headlines about what's going on in China. And until recently, that was all about geopolitics, about parts for missiles, about spying balloons, about technology. But today, I mean, a few days ago, we saw the Chinese authorities come up with their stimulus packages because the economy is not in the best of health, to be frank, in China. And Beijing is realizing, it had to lower the interest rates, lower the mortgage rates, bring in some new monetary instruments to help regulate that economy. And we've got quite a nice debate in PWM, a great debate between two economists, one saying, yes, these instruments will really stimulate the economy. They'll bring back the family offices, the big investors. And the other guy's saying, it's not enough. We need a lot more than that to really get China away from its semi-crisis state. So that's, a lot of family offices, they've divested away from China. I think they all have in the last 5 years. They're looking to the US, obviously, but also to India as the big emerging alternative to China. And the other question we're asking is, which hubs should investors use if they want to invest in Asia, if they want to invest in India and China? And that was a piece that I was researching for a few days. And Singapore, it's really stolen a march on Hong Kong in recent years. I was in both centres a few months ago, and Singapore is really thriving. There's new bankers arriving there all the time, new family offices arriving there. Hong Kong's fighting a bit of a rearguard action, and we've got some interesting views there on our website. But, some of the pundits are saying that there have been a few own goals in Hong Kong, that, yes, Singapore is so nicely positioned for the burgeoning Indian wealth management business, but, you've got that 800-pound gorilla just up the road, China. That's not going to go away, and the Chinese business will eventually come back to Hong Kong once they get their act together. But Ali, you've been writing about the Asian affluent investors, the next tier down from these major family offices and high net worth investors. What kind of a trend are you seeing with these guys?
Well, there's massive concern at the moment from these affluent investors. You may be asking, what is an affluent investor? It's an individual who has $100,000 to $2 million in investable assets.
So amounts me and you can only dream of.
Yeah, definitely. But yeah, in Asia, they're not ready. They're not ready for legacy or retirement planning. And, Yuri, that's a concern. We have an $82 trillion wealth transfer coming up in the next couple of decades. And, these affluent individuals, they cite, rising living costs. They cite inflation as being the reason. And, as a result of these immediate financial goals, they're struggling to kind of balance with, long-term goals. And, another point that really struck me when I was researching this was there are a lot of cultural priorities here. A lot of families in Asia, they kind of try to delay family planning because of cultural reasons, leading to hesitancy in making any kind of formal arrangements. And, another thing that struck me was, a lot of misconceptions about, the cost of succession planning. Some people don't understand the legal complexities of it, and that often leads to procrastination, which is a big problem for the affluent class. But also, succession is a big story for also family offices as well. The family office ecosystem is, is becoming a major financial powerhouse, as our colleague Elisa.
Indeed, Ali, and it's becoming a rival to the institutional sector, and I think Elisa was really outlining that in her piece, that when it comes to financing capital needs, infrastructure, climate change, the family offices are now becoming such a major piece in that jigsaw. And it's interesting to read Elisa's piece about just how important they're becoming in the ecosystem. And we know from the people we've been speaking to, and this is particularly the case in Asia, where I was quite recently, Ali, that they're all investing in real assets, in infrastructure, in real estate, in ports and railways. And a lot of that has the ESG kind of tint to it as well. Ali, in your research about real assets and investments there, what kind of trends were you seeing?
Well, we've seen in recent days, the conflict in the Middle East is a major concern for everyone. There's lots of uncertainty in geopolitics, of course, economics. And so private bankers, they're pushing clients into real assets, that may be commodities, real estate, infrastructure. And, they're really, paving the way in that direction. And it's part of a broader trend, I guess, to seek refuge from inflation and market volatility. And infrastructure is a big one, as you said. The big pension funds dominated such investments, maybe in the US it was, and also to some extent in Europe. But also now private clients are moving into that space. But as I said from some of my research, there's just not enough, accessible investments or investment routes into these into infrastructure. And so a lot of people are going to energy-related infrastructure as an alternative, which is it's a big trend at the moment in the industry. And energy usage is going to go up in the next few years. But another thing is there are multiple ways you can actually access these investments. There's, of course, a direct way where you can actually own the asset itself, so the real estate, the physical asset, or a precious metal. But also indirect ways using different financial tools like REITs or ETFs. And so there's
So in that way, you don't get 1,500 barrels of oil delivered to your door.
And I'm sure there'll be no space in my garden for that at all. But the fascinating thing is there's a big debate now whether is this just for wealthy families, or is it also for the ultra high net worth individual? Can they access it? And some of the amazing private banks I spoke to, they say, yeah, they can also hop on the ride. High net worth individuals can also hop on this ride, yeah.
Well, I think that's a really good point that you're finishing on there, Ali, is that private banks, I think they're going to, from the research we've seen over the last few years, their success or failure is going to be measured by their ability to manage these alternative assets, to manage a much broader book of assets than just the old 60-40 bonds and equities portfolio. So alternatives, Ali, they may not be everybody's cup of tea.
Definitely not.
But they're certainly playing an increasing role in this wealth management business.
Exactly, Yuri. And on that amazing note, I guess, this is all we have time for on today's show of PWM Tea Breaks. As you know, this is the first episode, but join us next week for our second episode where we'll be discussing more of these pertinent topics. Goodbye.